Good morning, everyone. Welcome to this month's RS Academy webinar. So today the topic for today is optimizing credit management for merchants. So our speaker for today, Mr. Temitope Dagilogba. So a brief bio of the speaker. So Mr. Temitope Dagilogba is a seasoned professional in finance, risk management. His journey started at the Federal Polytechnic Ado Ekiti with a passion for financial analysis and risk management. They've excelled in his career. From 2016 to 2020, Mr. Temitope served as a credit analyst at Union Bank of Nigeria, gaining valuable insights into the world of credit management. They assess risk, made lending decisions, and controls the bank's growth and risk management strategies. Currently, Mr. Temitope is the proud member of RXO International, serving as credit analyst since 2022. They've evaluated creditworthiness of business partners, manage credit limits, and support the company's global expansion ambition while upholding prudent risk management. Mr. Temitope's expertise include credit risk assessment, financial analysis, credit management, risk mitigation, lending decisions, and financial due diligence. So join us today to learn from Mr. Temitope Dagilogba. So Mr. Temitope, good morning, and thank you for coming and speaking today.
Yeah, good morning, and good morning, everyone. Good morning, the host. And it's my pleasure to be here today speaking on this very special topic that affects almost every individual in Nigeria and in Africa at large. And I am so glad to be sharing my expertise on this very topic, and I hope and I believe that we'll be going home with one or two insightful points as we embark on this very topic today.
Recording in progress.
All right. Is optimizing credit management for merchants. Be sure that we understand what this topic is about. So I want to analyze what this topic is talking about. Credit or loan. How do you maximize the usage? How do you stand and maintain your credit worthiness? How do you make the best use of the credit? Gets credit terms, what are the terms that one has to be conversant with when talking about credit or loan? What do we even need loan for? Who is qualified? What are the conditions that that embody the taking of loan and, using loan and credit. So I'll be moving forward to the slide. First, what is loan? What is credit? Is there any similarities between these two? And what are the differences between them? So firstly, I'll talk about what is loan. Loan, I'll say a loan is a financial arrangement in which one party, typically a lender, provides a specific amount of money to another party, often a borrower, with the understanding that the borrower will repay this money, usually with interest, over a specially defined period of time. Loans are a common method for individual businesses and even governments. Even governments to obtain funds to meet a various financial need and goal rather. So I want us to stress a very key word there. I said a loan is a financial arrangement between one party, that's the lender, providing a specific amount of money, to another party, right? That's borrower. I want us to stress those points. A lender, money, a borrower, at an agreed interest rate and a clearly defined, period of time. That's for loan. While credit is also a financial arrangement in which one party, just as we said in loan, the provider of the credit, that's the lender, provide now not money, not necessarily money, but goods, even services, and at times money to the other party, that's the borrower, with the understanding that the borrower will repay this borrow amount with interest, of course, at a later date. Credit allows individual businesses and even government to access funds or resources that they may not have, on hand, enabling them to make purchase invest or meet a particular financial. We understand the differences between loan and talk about loan. But when we talk about specific, what credits can provide, credits can be in form of goods. It can be money. So those are the differences between loan and credit. So let us, elaborate how they are, their peculiar, their differences in, a larger scale. Is it just about what they offer, like loan offer money, while credit offer goods and services and sometimes money? Is that all about the differences between loan and credit? Let's see. The scope of the itemized points there. We'll be looking at the repayment. We'll be looking at the interest. We'll be looking at the uses. We'll be talking about the tenure. We'll be talking about the terms and conditions under each of these. We'll now be comparing that of the loan and credit. So repayment structure in loan. For loan typically have a fixed repayment schedule, which include regular installments of a specified term. The interest and the principal are paid down with each installment. What am I saying in essence is that, let's say for instance, Mr. John, got a loan from institution A, say 100,000. So 20% interest of 100,000 is 20,000. So the principal and the interest of 20,000, which make 120,000. Structure in sense that this amount will be split into 6 different installments, right? Now, if we should split it equal installment, that means Mr. John will have to be paying 20,000 each month for the 6 months term that the total loan will be fulfilled. But that's when we are talking about loan. But is it the same when it comes to say a credit? No. Let us look at credit. When talking about credit, you can make payments based on the amount you've borrowed. Only the interest or a small portion of the principal balance. You have more flexibility in managing your repayments. What am I saying here is that, let's take for instance, there is limits to credit at credit line. What you are limited to use per time. Now talk about Mr. Andrew. Mr. Andrew is being issued with a credit with limit of 100,000 per month. Now, Mr. Andrew was able to use only 30% out of the 100,000 limits within a particular month. Now, the repayment for this credit will be based on only the amounts, regardless of the limits. The repayments will be based on only the amounts that Mr. Andrew used out of the limits. And in the case of Mr. Andrew only made use of 30,000 out of the 100,000 limits. So if the interest on this credit is 5%, that means Mr. Andrew will only be charged on 5% of the 30,000 that was used out of the given limits. So that is how repayment, and Mr. Andrew is meant to pay both the principal, both the amount spent and the interest on charged on it at the end of every month. That is, if it is monthly repayment, then Mr. Andrew will have to be paying all that was spent out of the credit limit and the interest charged on it. That is the repayment for. So what I just explained how interest is being calculated on loan and how interest is being calculated, on the credits. Now, another thing we want to look at is the uses. What do you need a loan for? What do you need a credit for? Loan are typically used for specific one-time purpose, such as buying of home, that's when we are talking of mortgage loan. Buying of cars, that's when we talk about, auto loan or financing a specific project. Do you understand? Now, the fund are disbursed in full for that specific project. That is why most time, what you can get from loan in terms of amount is always higher than what you can get from credit per time. But when we are talking about credits in terms of uses, the credit card or personal line of credit are more flexible and can be used for various expenses over time. You can borrow, repay, and borrow again, and repay and borrow again for as long as you can. It doesn't have to be one time. Once your limit is decided, then for grocery, you can use it. To refill your store, you can use it. For so many other things, you can use credit. Now, let's talk about the tenure. That's the term. Oftentimes, loan is characterized with, say, a very longer tenure, because the amount we are talking about here is a large sum. So you are not expected to pay back in a very short period of time, except on rare occasion, when you just feel like, okay, you have this money and you just want to clear your obligation and you want to be free of all forms of loan and every other thing. So mostly, loan is being spread over a long period of time. It could be 2 years, it could be 1 year, 1.5, that's 18 months, 24 months, 36, and all like that. That's loan. But in credit term, it's not like that. You are always meant to pay back at the end of the month, whatever you use out of your limits. Out of the clarified limits, you are always meant to repay it with the interest, and you are always having the access to it after repayment, because it is revolving. Like every other month, you make use of it, you repay, you use it again, you repay, it goes on and on like that, unlike loan dealing with repayment for, the span of the tenure. That's how credit works. And that's how condition, okay, I just mentioned, we'll dwell more on condition as we go on in the discussion. So what are the importance of, why do we even need loan in the first place? Why? Is there any importance? Is there any need for this thing called loan? Why should we get a loan? Why? What's the need? What's the need of loan? Well, more on loan than one can ever think of. Any progress wishing industry or business or person cannot do without loan. More and more popular. as they offer a organic funding to either grow their operation capital is estimated to be around 68 to 70%, and that's without capping. So what do they use it for? As a matter of fact, some individual with brilliant ideas, they take loan to start up a business. That's when we talk about startup loan. Some that feel that, okay, they are saturated and they want to expand, they even take money, they take loan, to expand their business. So when we talk about growth, when we talk about expansion of businesses, we cannot do away, with loan. When we talk about asset acquisition, when we talk about, sometimes you even need a loan to pay off a loan. It happens. When we want to finance a business acquisition, you can get a loan. Fund a marketing campaign, you can get a loan for, wide range of stuff that, that could be beneficial to your businesses and even your individual life. So it's very, very important for growth without capping. Let's move to the next slide. So having said all about loan and everything, what is loan, why do we need loan and every other thing, let's talk about who actually can get loan. This is when it is becoming more tricky. Actually, everybody needs money. You and I need money. But who can actually get this money from financial institutions? Now, we are not talking about friend-to-friend borrowing and lending. Now, standard financial institution, whether it is who can get loan or credit, eligible to get this credit from any company at all. There is something called credit worthiness. You have to be credit worthy. How can I be credit worthy? Somebody is asking already. You are saying, how can I be? What do you even mean by credit worthiness? How can I be credit worthy? What is even credit worthiness? Are there any factors responsible for, that are responsible for one's credit worthiness? So we'll be talking about this here. What is credit worthiness? When we talk about credit worthiness, it's often talking about the likelihood of this person that wants to get loan to be able to repay. And this person actually repay, because financial institutions don't want to just dash their money out to, loan shark, people that will just take loan without, a proper plan or capability or character or, what it takes to repay this loan back. So industries want to check if you are credit worthy. So credit worthiness to a person, it refers to a person or entity or company's financial ability or, reliability, how we can really rely on them to repay this borrowed amounts or meet the financial obligation. It is a measure, internal measure by the lending institution, to check every details, every metrics to be sure that, okay, this person can be certified credit worthy. And there are some factors that are responsible for that. We talk about the person's character. We talk about the person's capacity. Is there cash on ground? Is there capital? Do the person even have collateral to obtain this loan? What are the conditions that that surround a whole lot of things? But we will be tailoring our scope down to just 5 C's of credits, which are the characters, which are the capital, collateral, the capacity, the condition of the loan. That's what we'll be talking about. So I've, drawn it down to layman's standards, people will easily comprehend. So I'll be talking about the credit history of this person. When we talk about credit history of under creditworthiness of a person, a prospect that want to borrow from a financial institution, a credit history is a significant component of creditworthiness. It talks about your past borrowing and repayment behavior. Lender want to review your credit reports to see if you've paid past debts on time, not just if you've paid, now if you actually paid back on time. They want to check the amount, the number of your late payments. They want to check the number of your defaults. They want to check your, all those things so that it will keep them abreast of your attitude when it comes to repayment. Now, there is another thing called credit score. Credit score is like a model where all these other factors is being calculated. Maybe your character, they want to give it 2 points. Your repayment ability, they want to give it 2 points. And after every other thing that is being considered, every other factor is being considered, now they will now measure what is the total credit score. What is the total credit score? Now, this credit score is relative to different financial institutions. In Class A industries, Class A financial, we talk about those standard commercial bank. They often go with 75 to 80% score. But for Class B, because they are exposed to more risk, they have bigger risk appetite, and that's why they have higher interest rates. The higher the interest, or the higher the risk, the higher the interest attached. But we'll be going into that, maybe not now, maybe if I have a chance to come on board again, and the topic given to me is related to that. But now I wouldn't want us to get distracted and stay focused on what we are talking about. Credit score is just an internal model that financial institutions use to measure every other factors. It is what we give them your standard. Now, we talk about DTI. What is DTI? Debt to income ratio. Credit institutions want to measure that too. What is your income? What is your income? What is your, what is your take home for salary here now? What is your salary compared to what we want to give you against your supposed repayment per month? So I want to give a scenario here so that we can understand. First, let us keep in mind that the standard repayment percentage per person salary, that's by CBN, is 33.3%. Having said that, let us look at Mr. John that earns 100,000 per month. And CBN has given us this standard that from Mr. John that earns 100,000 per month, whatever loan you give Mr. John, you are not allowed to take more than 33.3% of Mr. John's salary per month for loan repayment. Okay, now, so whatever loan you want to give Mr. John, you are not, you have been restricted to just 33.3%. So when we talk about 33.3% of Mr. John's salary that earned 100,000, we are talking about 33,300. You cannot go beyond. That is, whatever loan you give Mr. John, you cannot collect back more than 33,300 from Mr. John's salary monthly for a payment. Now, Mr. John obligation to be fulfilled with institution A. And for that obligation, that obligation takes like 10,000 from Mr. John's salary every other month, which means Mr. John is only reduced to 90,000 every month. And out of the 33.3%, Mr. John has already exhausted 10% of, 10%. So Mr. John is left with 23.3. So Mr. John wants to get another loan and he approached financial institution B. So whatever a loan or credit aid that's financial B want to offer Mr. John, the repayments for it should not exceed 23.3 because Mr. John is already committed to an obligation that take 10%. So you are left with 23.3. So this is when the ratio comes in, debt to income. The total debt of Mr. John at the point of approaching financial institution B is, 10% debt to income out of the allowed 33.3, which means if financial institution B want to issue Mr. John with loan, he cannot take repayments beyond 23.3. So, but there are ways of doing it anyway. Financial B can decide to give Mr. John any amount Mr. John wants, but financial institution B will have to, elongate the span of the term. That's the tenure of the loan, so as to beat it down to the affordable, the affordable repayment that is left. That's that about that. Let's talk about collateral for secured loan. Some loans are not just unsecured. This scope of topic will not allow me to talk about type of loan and every other things. No, we'll have talked about secured and unsecured loan, collateralized loan and non-collateralized. Let's just assume that we all know what secured loan means or collateralized loan means. Or let me just say collateralized loan are loan that require you giving, collateral or security, some form of security before you can get the loan. So this person, Mr. John, that approached this financial institution, does he have the collateral, to secure the size of loan is requesting for? A financial institution want to check that to know that, okay, this person is actually credit worthy. The repayment history is also there. The repayment history. The credit utilization is there. Length of credit. Okay, let me talk about this length of credit history. Among ourselves, you can say that, okay, Temitope has never borrowed money from any institution before. This is the first time of him approaching an institution. As a matter of fact, when we conducted the credit check on Temitope, there was no data. Somebody will be happy. A financial institution that probably doesn't know so much about credit worthiness will be happy that, okay, he doesn't have data. So we are sure that he's not the kind of person that borrows money up and down. But no, in real sense, a financial institution should be happy with somebody that has a very long credit history than somebody that doesn't have at all. Why? If you, as a person, you've heard about Temitope, that Mr. Taye to get loan over the time, in fact, for the past 5 years. And Mr. Taye has always been giving Temitope loan. And Temitope has always been repaying without default. Now, compared to somebody that never payments, good customer that has been approaching institution to get loan and repaying back, they understand, the idea of credit management or financial management, financial are able to fulfill this obligation over the time without default. So that's a very good one for any financial institution that knows what it's doing. To put you in debt and have you repay. They're happy to see you that, okay, you've been managing credit for so long and you have never defaulted, and okay, they'll be happy to even give you more. That is why an institution that knows what it's doing should not toy with record. But then that's the next slide. The difference between loan, I've spoken about difference between loan and line of credit. But then this question comes to mind as a person. You need money now, but you are confused. Should I go for a loan or should I go for a line of credit? Which one should I go for? You are confused, you don't know. But allow me to tell you, anybody that wants to go, that is confused about these two, must first of all ask his or herself that, okay, this loan that I want to get, what do I need it for? That will guide us to knowing what exactly we should get or which exactly we should go for. As I said earlier, loan is being paid once. It could be a very huge amount of money, say 5 million for 5 years, or say 3 million for 1 year. When loan can only offer you 500,000 for 1 month. Now I want us to do the calculation. You want to buy a land, and the land actually costs you like 2.5. Why loan can give you 3 million and a line of credit can give you 500,000 per month? Which one will you likely go for? It's simple. You go for loan because of what you intend using it for. So it's a question of what the fund is needed for. But for a company that want to expand, that want to, acquire assets, that want to acquire a new car, you cannot get a new car with credit. No, you go for loan. However, there are places where low credit is useful. why you can get loan, 3 million loan for 1 year, you can get credits 500,000 credit for a month. So if you use the whole sum of the credits for every other month in a year, you will have used 6 million. Like 500,000 times 12, 6 million, 3 million for a year. So it's a question of what do you need this money for? Credit line is a revolving kind of credit, money. Like you get it month in and month out, you pay, you get it, you pay you. So if you intend expanding your business within your already your present location or your present premise, it is better to go for credit. But if you intend acquiring an asset, an equipment, or say expanding to other premise or other location, it is better to go for loan. So that's, having said that, there are conditions, there are some terms that has to be considered when talking about loan and every other thing. So I'll leave the agreement for now. I'll talk about agreement later. There is something called principal. Is being discussed. That's what you sign up for. It is the wholesome. Now, in credits, this can be different because you have a limit, then you have what you actually use out of the limit. So regardless of your limits, what you actually use out of your credit limit per month is your principal when it comes to credit. But when it comes to loan, because it's a one-time payment, then what was disbursed to you as at the point of disbursement is your principal. Now we talk about interest rates. The interest rate is what the financial institution stands to gain after giving you the money you were given. So institution, the charge is no. So your time is the length of the dates meant to pay on file on the accrued interest. Now there's also something called recovery. Recovery only happens when after a period of time, you've been called, you've been spoken to as regard your repayment and everything, and yet you refuse to pay, then there has to be recovery. Recovery is when the collection team actually approach you and probably they have to put it on you to make repayment, or they make use of your collateral to liquidify your loan. That's when a recovery comes to play. So already I think I've spoken about this. You want to expand, you want to grow, you can purchase, you can get loan to, to purchase fast-moving inventories. You can upgrade your equipment with loan. You can expand your location. You can even launch new products. You can offer, if you get loan to get enough goods, then it will allow you to offer reasonable discounts to your customers. You can expand your services. You can hire more employment after getting loan, because you now have more services or goods to sell. Now you can increase your online presence, and sometimes you may have to pay off some debt, some threatening debt with another loan. It happens. It only boils down to the difference in interest between the two loans. So your loan. Now, you've gotten the loan. So how do you make sure that you make best use of it so that you will not end up defaulting and find yourself in trouble or stress? As it can be seen on the screen, managing your loan or credit obligation effectively is essential to maintain good financial health. Stress. I'll talk about stress later. But what can you do? What are the first thing to create this budget will put you in best condition to know what part of your salary or your income or your inflow should be going to the repayment. How can you manage, the remaining, to be able to be responsible for your daily need at home and every other thing. Now, you can create a repayments plan. I have a customer that takes a credit of 3 million on a monthly basis. And since I've known this customer, I've been servicing this customer over a year now, this customer has never for once paid a lump sum of 1.5 million at a time. No. Why? He understands his business and he has set a distinct repayment plan. Every day, this customer pays 100,000 or 50,000. So before the month runs to the end, he will have cleared the 3 million. And even if it remains something, it won't be more than, say, 500,000 or 600,000. Any obligor to set a distinct repayment that fits his line of credit business, and that wouldn't stress him or her. You can also make use of what is called emergency fund. The emergency fund is your piggy bank. You want to have a piggy bank where you drop your 5,000, you drop your 10,000 on a daily basis as it comes. You want to drop everything. At the end of the day, when the plan didn't go as planned, as wish, you can always fall back to your, emergency fund. You can purchase prioritize interest debts. You have a number of obligations you are servicing, but then one carries more risk than the other. One carry more interest than the other. So first thing, you want to prioritize the one that is more threatening and pay it off on time before settling those small ones. So it is very important. You want to pay your bill as soon as it comes, so you won't have to pile it up to the end of the month. No, as it comes, pay your bill, your electricity bill, just pay it. Let that one be out of it. Then you pay your bill as it comes so that you don't have to be stressed at all. Then it is very also important to live within your means. Don't do Don't do buga, don't do buga. Just live with it. When you are subjected to obligation, you have to learn to live under your means. That is why setting a detailed budget is very important in the first place. So you have to also limit the acquisition of new credits. You want to seek financial education. It's very important. That is very important. It will help you look at your finances, your inflow, the size of your inflow, the size of loan you should get, and how to manage repayment, that it won't affect your life, your day-to-day life. It is very important. Our time is fast spent. I want to rush it now. Now, stress in obligation repayments. What is even stress in the first place? But then detecting stress in the repayment of financial obligation is crucial to addressing potential issue before they even escalate. So I itemize some points here. When you start noticing that you are missing or you are paying late, it's an indication of stress. When you notice that you started using credits to make payments, like you want to pay, you want to fulfill an obligation, you quickly run to the next door to borrow money again to settle the loan, then there is an issue. When you start receiving call from collection team, then there's problem already. As it is there, you also can see, when your quality of life starts reducing, that you can no longer afford 3 square meal, or you can no longer take your car to work again because of cost of fuel and everything, then there is something hitting you up. It is an indication that things are no longer going as planned. So you want to watch out for that. So when that kind of thing happens, what can you do? Or what brings about stress in the first place? What causes stress? Or what is stress? It says stress is the state of difficulties in fulfilling obligation, be it loan repayment, bill settlement, rental, or even grocery, your day-to-day life. You can like when it becomes difficult to afford the minimum things of life, then that is stress, is an indication of stress. What brings about stress? First is poor financial management, high debt level, unaffordable interest rates. People will say, that Gbomule Lanta is like a loan with a killing interest rate. So you don't want to put yourself into that. Sometimes unforeseen expenses, that is why you need a piggy bank to serve as a saving grace when it comes to an unforeseen expenses like that, so that it will not affect your repayment plan that you must have set in your budget. Poor sales record keeping is a problem. Or income leakage. Somebody is stealing your money. Maybe your sales rep is stealing your money. Your sales guy is stealing your money, or somehow things are not going as planned. Those are the problem that causes stress. So you are in stress, or you have detected an impending stress, and you want to put a plan in place to guide against it so that it will not affect you, or you are already in it already. What can you do? You have to sit down and reassess your financial situation. It is very important. Look at the reality on ground. What is obtainable? What is coming in on a daily basis? Where do you currently stand? Forget about your previous stand, but your current reality when it comes to financing, or when it comes to your financial, you want to reassess it, check it. You have to set your priority right. You have to be able to redefine the need from the want. And if it is possible, you can supplement your income, like look for another, guys will call it side hustle. You understand? Look for side hustle. Look for some other ways of, strengthening yourself in terms of income. You have to create a budget now. The budget this time will be based on your current situation, not the budget you set at the initial stage you got the loan. You have to come to the realization of the current situation of things. Then, based on the current situation, you create a new budget. Now you have to contact your creditor. There is no problem. Yes, things are not going as planned. Okay, contact your creditor. There are other ways of easing you of the stress that the creditor can come up with. One of it is loan rescheduling and restructuring. Let's say you are meant to pay back your loan in six months. $50,000 back every month. When you apply for restructuring, it could be reduced to like say 25 or 30 so that you won't get too stressed. You can seek financial advice by financial experts, from financial experts. Financial experts will help you look at your reality, your present reality, and advise you. If you have to sell some assets to, liquidate your loan or offset your loan, or you have to go for loan restructuring, or even migrating from one class of loan to another that will ease you. Then you have to also look to block all forms of financial leakage. It is possible. You can look at it that way. If your case is like you having say some form of financial leakage, you block it. You block it. Maybe you reshuffle your staff. All sort of ways around it. Just find your way and block all possible financial leakage so that you can be okay in that sense. And conclusively, now this is our last slide. It is important to note that while loan can be a powerful tool for businesses, business growth, they can also come with responsibility of repayment. Of course, it's not even a matter of they can also. They comes with responsibility of repayment. That is when prudent financial management and well thought out business plan are crucial to ensure that, okay, the borrow fund are used religiously, wisely, and that the business can generate the necessary cash flow to service the obligation. Business should carefully evaluate their financial position and term of the loan to make informed, borrowing decision that align with their growth objective. There is loan, there is repayment, there is a place of planning to ensure that you don't get to get stressed or fall into default, everything like that. That's conclude this session. So I would like to take question or contribution from anybody in the house now.
Thank you so much, Mr. Tope. It's been a wonderful and enlightening session. I don't know if anybody or call has any particular question. You could unmute yourself or you type the question in the chat box. Okay, Mr. Sebastian Ikejide, please go ahead. Hello, Mr. Sebastian. Okay, I would like to take it that what Mr. Tope did was wonderful, that we have no questions and we all clearly understood this. So thank you very much.
Hello, sorry, Mr. Dari. Please, I have a question to ask, sir.
Please go ahead.
When he was talking about stress, yes, stress. When stress is being identified.
Okay, please go ahead.
Especially in the process of credit money. Can a financial institution recommend? Yes. At what point in time can a financial institution recommend a restructuring, or the customer apply for restructuring for an extension from their financial institution? At what point in time can they do that?
Okay, thank you.
Thank you.
I believe I mentioned that in the course of the presentation. However, there are some institutions that are assigned managers to their public their debtors. So the work of this manager is always follow the repayment of the obligation. So if this manager is that truly follow up with the repayment, then he will some form of sign of stress in the repayment pattern of this obligation. Do you understand? Like the manager should be able to notice some kind of stress in repayment your repayment. So that's as soon as the manager notices stress that is not intentional, then the manager can inform or alarm the institution. Detect this. I detect this going on with my subjects. Now, if it is not coming from the manager, then it can come from the debtor concern. The debtor, what is being paid out in the market at the moment, should be able to ensure what is likely going to happen in the next 3 months. I don't know if this customer is there is a sign of trouble in the horizon, then he or she quickly contact the financial institution and bring them the knowing of the situation of grant and prove its and it is the organization say, okay, now this is the solution that we can refer to your problem. We have to wait and observe till a certain period of time, come up with as the case may Now, the decision is left to the financial institution. I don't know if you have been able to answer your to the financial institution.
All right, I thank you very much.
Okay.
Yes, for us.
Sorry, I could not hear you. What's the problem here? What's the issue?
Structure on it.
Ah,
So they want
ah,
to take advantage of that. For example, recently you can understand why some of tenure over 51 days and 81 days away, where at least they can have is going to be attached to the